Kia ora koutou, welcome to Shared Lunch. I'm Garth Bray. Well, winter is here, not normally a boomer of a time for our property market, and the Reserve Bank is sounding a little lukewarm about easing rates further, so what lies ahead for us? Time to check in with that sage of the savvy property investor, Tony Alexander, see what he thinks. But before that, some important information you should always consider before investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Tony, a rare pleasure to have you here face to face in Auckland. Lovely to have you with us. If we look at what the Reserve Bank came out with, which was effectively a little bit of a split decision there, they took some convincing the full board that a full cut was needed of 25 basis points. Apparently they didn't even talk about cutting 50. What do you take out of that?
Yeah, I wouldn't have voted for a cut. I would have stuck there at 3.5%. Yeah, I know people don't want to hear that because I've said the economy this year weaker than people were thinking. That sounds like less inflationary pressure, not so quick. Because the other thing I've been saying since August last year, on top of the economy's going to still be a bit weak going forward, is there are still inflationary pressures bubbling on underneath in the economy.
Where are they coming from?
They're coming through the business sector generally. It's when you go and buy your cheese also at the supermarket there, or your meat. So the high commodity prices, great news for our farmers, horticulturalists, etc. But it feeds through into the supermarket, so we feel it there as consumers. But just generally, the costs are still rising out there. And I've talked a lot about price setting behaviour by businesses. And if we look, for instance, at the ANZ's monthly business outlook survey, on average since 1992, when inflation started settling around 2.5%, on average a net 26% of businesses have said, I'm raising my prices within the next year. That's still running at 45%. So we've got a well above average proportion of businesses saying, I'm putting my prices up. And this is when conditions are still weak. We've had recession or two recessions in the economy in the past 3 years. You would expect that number to be way, way down. And of course, it comes from a net 73% of them are saying, my costs are rising, I expect them to go higher in a year's time. So my concern is that monetary policy aims at where things are going to be in 18 to 24 months' time. Well, I expect the economy is going to be stronger. And when I look at the ANZ survey, and I offset it against another survey from the New Zealand Institute of Economic Research, they've done that survey since the 1960s. What it says to me is this: once businesses see customers coming through the door in good numbers, like next year, they're going to raise their prices to rebuild margins.
And that will bring the inflation back.
The inflation will come back. And so that's why I think the Reserve Bank's mind now has shifted away from, right, we no longer need high interest rates to crunch inflation, to let's be careful we don't continue the whipping around behaviour of the past 1 to 2 decades and cut too far now and have to rapidly increase late 26, 27.
Right. They really are taking quite a long view there. Hard to get that long view, though. I mean, you saw Christian Hawkesby, who's acting governor at the moment, came out kind of with it's not just what we see in front of us, it's what we see either side of us. Yep. They had these alternative scenarios, which I kind of boiled down into my head to, we're facing some headwinds, and it's all going to get more expensive, or we're facing these headwinds and we're just kind of going to give up. The whole economy is going to go into a coma, globally almost. Am I way off there?
Yeah. No, the world economy is still going to grow. Like I was reading commentary this morning about the OECD have slashed their forecast for world growth over the next 2 years. Well, that was the word that was used in there. It was only a reduction of about 0.2% in their forecast this year and 0.1% next year. So people
media
have to
beat up.
It's media. What are you going to do? But we pay attention to. There's a shocking headline. And we read it, but the actual change is relatively small. And the Trump tariff war that's underway, it's a definite negative for the world economy. There are two minds on: does this boost world inflation or lower it? Even Treasury and Reserve Bank can't agree on that one for New Zealand.
Hence those different scenarios.
Scenarios.
Where are we going to land here in the next sort of 6 to 12 months? What are we seeing?
Still slow recovery, which will strengthen in 2026, but we shouldn't ignore the fact that these are good prices for the farmers being received out there. They will gain some greater confidence, do some spending, and contrary to what I was thinking up until a few months ago, where I said, I think the recovery is going to be broadly based in the economy, it will now start more in the regions. You see it first in Invercargill and Dunedin. Christchurch gets it, Taranaki, Bay of Plenty, Waikato get it. Auckland will be seeing it early next year. Wellington, maybe 2027. Something will flow through. It's just the normal lag in the process. So broadly, economic recovery is underway, but my message to people when it comes to borrowing and interest rates, this is almost as good as it's going to get, almost on the mortgage rates.
That was exactly what I want to ask you next. You're seeing banks now actually jousting again. I mean, they're skiting about the fact that they're under sort of 4.9% for 18 months. Like that's a wonderful sort of a number. Not bad, I suppose, in recent times. We've seen a lot lower. What's going on there? Are they just trying to scoop up some of those? I think it was like $30 billion a month that were going to be rolling over their mortgages. I think was the plan
a lot of people.
months.
Because everyone's been fixing sort of 1 year for a number of years now. Not many people locked in for the 5 years at 2.99%, as I was jumping up and down saying I would do for 11 months starting exactly last week 5 years ago. That's when we had the 2.99% for 5 years first appear in 2020, and it lasted for about 11 months. And so you just got to think there's actually a group of people out there for whom their interest rates are now jumping up from 2.99 to 4.99 or so. Poor beggars. All that. Well, at least they got that time, at the lower rates there.
It'll be a shock.
It'll be a shocker for them out there. Don't anticipate that the interest rates go much lower than they are at the moment. The financial markets are looking towards a future where global inflation is slightly higher, US budget deficit blowout, etc., places upward pressure on medium to long-term interest rates everywhere, and there is an economic recovery underway in New Zealand. It's hard to talk about interest rates still needing to be cut when there's an economic recovery underway, duh.
Yeah, right. There's no more medicine required. Does that mean, I suppose, if you're in a position where you're watching these rates and you're thinking, oh, maybe I should break, it's like, well, everybody's situation is their own. We should say this is not financial advice. Your own circumstances dictate what you should do. But potentially something to consider is, hey, it's going to be a longer interest rate picture for...
If I had a mortgage that was maturing, let's say, in 3 months' time or 6 months' time, I wouldn't feel a need of, oh, hang on, I'd better get in right now because inflation's going to jump up and in 3 or 6 months' time the interest rates are going to be 0.5% higher. No, I don't think that at all.
You don't see that?
No, I think and even if people are going 1 year fixed or 2 years or 3 years, it's going to be, here or there, 6 of one, half a dozen of the other, because I can't yet see enough form in the interest rates outlook to say this is when interest rates are going to start jumping up. This is how much they're going to go by. I'd want to get cover against that.
Probably it's the other side of the equation. It's the employment picture that's more important at the moment, isn't it?
Yeah, well, that's, I think, one of the reasons the real estate market is still being held back. So in my monthly survey of real estate agents, been doing it for 5 years now. Now, on average, in 5 years, 21% of the agents have ticked the box saying buyers are worried about their jobs. At the start of 2024, that was 14%. So we started last year with stronger than average job security in the economy. It was wonderful. Well, come June last year, 56% of agents saying people are worried about their jobs. And my latest survey, I just sent out the results of that, 51% of agents still say people are worried about their jobs. And I think that's one reason the housing market has failed to continue the recovery we saw in the second half of last year, and why, for the second time now since the start of 2023, a recovery has fizzled out again. And I think the labour market is one of the factors in play.
And you see it at all levels, I guess, because if you're not selling, you're not buying, you're not seeing people transitioning out of homes into retirement villages and so on. Everything kind of slows down, and you're still seeing listings and you're still seeing stuff being built, right? Yeah.
Well, the level of construction out there still seems pretty strong. In fact, as I've been pointing out to people, one of the structural shifts in New Zealand, relevant to why house prices won't rise as much on average in the future, is that the level of construction versus the population is now higher than we've had in the past. So more supply coming forward, land being made available, densification, intensification, etc.
The consent stuff as well. I mean, they're talking this private consenting outfit that's saying we'll get you a consent if it's simple in 10 days. You've got the government requiring councils to say, how well are you performing? And apparently that's lifted it from like 80% in time to like 90, more than 90% in time. So there's like, the system's working better, isn't it? But that means more supply, therefore perhaps lower prices? More
supply coming forward, not so much lower prices, although a net 38% of real estate agents at the moment say prices are falling in their area. Oh. So that's quite a strong result. We're almost back to where we were in the middle of last year.
I was looking, there was a story this week about how the listed property trusts out there have seen their valuations basically kind of hit the bottom and start to build again and there's more interest there. Do you take any kind of indication from that end of the market?
Don't look at that at all myself, no. I look more at what I'm picking up from my surveys of the agents, the mortgage brokers, the property investors, etc. are out there, and that tells them what's happening right now. I mean, the market will turn around, but I'm thinking this is more a story for 2026 than it is for 2025. With the labour market uncertainty at the moment, the strong supply that sits out there, net migration only plus 26,000 in the past year. 2 years ago, almost it was 135,000 net. The average for 10 years net migration gain for New Zealand is 50,000. So let's say we're running at about half average, recent average at the moment. So whereas a year ago, or just over a year ago, in my survey of property investors, of landlords, I had about a net 25% of landlords saying, it's easy to get a good tenant. It's bonza, no worries. Now I've got about a record net 33% or so saying it is hard to get a good tenant. So for the moment, the real estate market is subdued. It's a buyer's market. Personally, if I were a young buyer or an investor, I'd be expecting to have a greater chance of finding exactly what I want to suit me, my family, my portfolio, compared with, past couple of decades.
And I mean, are you getting that sense of confidence because you speak to property investors in large numbers? What are they telling you? What are they giving you?
The investors are interested in buying, but it's like when you see a market relatively flat, you're thinking, am I missing something? If they're not buying, maybe I shouldn't buy as well, because we're social animals and we take our cue for what to do from what other people are doing. This is the test. There aren't many Warren Buffetts. The sort of person who, when everyone else is going that way, he goes, no. I go this way. This is part of that challenge, that for the moment prices aren't rising, and so you're thinking, well, if I buy now, what if the price goes down 3 or 4%? Will I feel like an idiot? And we call that FOOP, fear of overpaying. And so I've got a measure of that from my real estate agent survey as well. And now and then I'll do a graph of FOOP has gone up. So the more recently, over the past 4 months, more buyers are worried, I might buy and then the price goes down. Whereas FOMO, only 5% of agents say buyers are feeling FOMO. It's a buyer's market is all I can say.
Wow. Despite the FOOP.
Despite the FOOP, yeah, that's right. Hey, no one's going to pick the bottom. You can't pick the top. And you've got to be thinking, if I'm buying a property, I'm probably going to be in it or owning it as a rental for a great number of years. Seriously, who gives a great worry at all about what happens in the next 12 months? Yeah.
Yeah, that 12 months won't matter 20 years from now.
Surely not. Trouble is, we all live in the short term.
The Centrix data that we've seen out very recently, the credit reporting stuff, that shows business and consumer credit up. I mean, it's not, the lending is not where it was in 2021, but is that the first sign that things are getting better, or is it still not looking great?
We economists don't generally look at the lending data for a sign of what's happening in the economy. We tend more to look at leading indicators, what's happening with consumer sentiment, business sentiment, these sort of things, investment intentions, employment intentions. So definitely interesting there. But for instance, if you look at the Reserve Bank's lending numbers, the volume of lending to the farming sector is down about 1% or so on a year earlier. So do we look at that and go, farming's falling away, it's all getting really, really bad? Well, not with commodity prices up about 17% on a year earlier. So
they're probably just paying off debt, aren't they? Because things are so good. So it's actually a healthy sign.
That's relevant, because if we talk about the good returns being made by the farmers, the region's going to boom. Rural towns are going to absolutely boom. Right, that's where I'm going to do my property investment. Yeah, well, just remember the costs for operating a farm have gone through the roof in recent years. And yeah, they've been getting a voice in their ear to pay down debt for a long time. So the actual regional stimulus is going to be there, but it's not really going to be what it's been in the past coming out of recessions.
Just on that though, I looked at that Centrix data and there was like a heat map of how badly in arrears, how badly behind people are. She was lush green all up the South Island, all in single digits. You get up into pretty much the whole of the North Island was a bit of an orangey, and you get to Bay of Plenty, you get to the East Coast, Tairāwhiti, it was red. And we're talking like 17, 18%, in arrears and so on. That's not a healthy sign. That's a two-track economy there, isn't it?
Well, yeah, for the moment, I think it does look like that. And in a way, it's sort of a payback in a broad sense from earlier on when we saw, from a housing market perspective, things were growing really strongly in the North Island, but not in the South Island. I used to talk a lot about it, that this boom in house prices, there was some in the South Island, but it wasn't as much as in the North Island. And so if we extrapolate that to businesses in general, probably you got more businesses getting over-optimistic in the North Island than the South Island during the previous boom. And so when you get the tight monetary policy occur, there's more weeding out to do in the business sector, maybe residential property investment market, in the North Island than the South Island. So that's sort of what I would put it down to. I wouldn't over-extrapolate that towards, right, New Zealand's future for the next 100 years, right, it's back to the South Island. This population imbalance, 25% in South Island or so, 75% North, it's going to reverse. Yeah, no, it's just a bit of a cyclical thing from that earlier on boom, which was more in the North.
It just must be anecdotes that I keep running into people that are moving to Christchurch then to try and ditch the Auckland property prices.
Oh, that's definitely happening, and it's going to keep happening as well.
Yeah. I mean, liquidations and some of that data were quite high. Business liquidations, we're talking like 30%, I think, was it up on year? That's not good.
Yeah, definitely not good. But this is what I warned about from 2022. In fact, as early as the first half of 2021, I was warning residential builders, just watch out. There's a boom underway. Lots of inexperienced, undercapitalised people are entering the residential construction sector as widely defined, and there's going to be a weeding out period somewhere down the track. And then I morphed that into talking about over 2023 of this weeding out is going to be across all sectors of the economy in 2024, and so that's what we saw with liquidations up, etc. last year. And then, of course, I was warning strongly from August last year when we saw the interest rates were coming down. A journalist wrote, we're going to be a rock star economy again, and I thought, what a load of absolute rubbish. There are going to be businesses that are going to be caught out, and some of the weakness we see in the economy at the moment, it's the reality check, as I think businesses are realising, oh, he was right, this isn't a boom. We survived to 25, it's not enough. And some businesses, either from their own volition or the IRD or the bank, the creditors are realising we can't make it. If we don't have a boom, then given the costs we've got going up, the massive margin compression, we've got to close down. And so that weeding out process is still rolling through 2025, especially as the Centrex data showed in the construction sector, where there was a much sharper increase in number of liquidations, sort of trending upwards in the past 3 years, compared with other sectors like retail, hospitality.
Because broadly, I think this month it actually turned, or last month it's turned, and it almost looked like the worm is turning down. The liquidations might just be starting to trend down. You don't think it's over?
It'd be nice to think that, but I think it's too soon to really call that. Having said that, although my commentary since August has been a negative, quite shockingly so to some people, I do have to keep emphasising there is still a recovery underway. We've got the absence of those crunching interest rates out there. We have the surprisingly good returns in parts of the primary sector, more foreign students coming into the country. There is some business investment, infrastructure. So there is a recovery underway, but it's not an especially strong one. It's the absence of the strong upturn which is catching out some businesses just in the last gasp of their breath for this year.
Just thinking back to the budget, there was some supposedly long-term thinking in the budget there around things like Kiwi Saver and so on. Was there anything in there that jumped out and made you think, crikey, we're on the right track here?
Right track in terms of?
Well, just in terms of the long-term plan for how we get people saving more in a position to be able to either invest in property, invest in whatever they're doing. Are we answering that question?
Well, the budget wasn't focused on that. The budget was all about putting in place a better fiscal track to get the Crown accounts for New Zealand ready for when the next shock comes along. I mean, you can virtually guarantee within the next 10 years there's going to be another major shock hit the New Zealand economy. We've just got no idea when, what it's going to be, how bad it's going to be, but the accounts need to be ready for that, especially given our high dependence in New Zealand on people saving overseas. We use their money. And so, yeah, improving savings is definitely a positive, I'd suggest, for New Zealand. But the budget wasn't aimed at doing that. And unfortunately for Kiwi Saver, from my point of view, right early on when businesses were allowed to opt out of making a contribution by saying, oh, we're going to put it into the person's salary instead of contributing 3% ourselves. Well, I'd suggest most people who had it put into their fully costed up salary in that year might have noticed I didn't get much of a salary increase in the next 3 or 4 years after that one. And I think for me that's a bastardisation of Kiwi Saver away from what it could have been.
So, and it's too late to try and fix something like that, obviously, because the costs are quite high there. You've just got to try and work on it. Yeah, right. It's nothing else in there, obviously, for the tweaks that they made to things like contributions. It's all sort of water under the bridge.
Yeah, it's neither here nor there, I think, in terms of the outlook. Do I think, suddenly there's a big pool of savings and this is going to provide capital for growing New Zealand businesses? No. This was hardly even at the margin sort of stuff there. It really doesn't classify as anything major. Even when we look at something like the 20% first-year depreciation allowance businesses can claim for their investment. And it sounds good, and I'd say, yes, it is a good thing. The issue is a lot of businesses were already saying I'm going to invest. And now I can claim more this year. Oh, wacko. It's going to be of cash flow assistance, and it might stimulate some more business investment in New Zealand, but it doesn't really change the outlook. I'm not actually aware of anyone who's actually changed their outlook for our economy on the basis of the budget. I certainly haven't.
So, yet apparently it's going to increase our GDP by, I can't remember the figure by so much, but enough to sort of nudge it up by more than 0.5%.
I think it was going to be 1% over 20 years.
Oh, okay.
So full credit to Treasury for actually writing that. You're saying, yes, there's a positive impact, but by the way, it's the next two decades. And they're probably right. It is probably going to be something like that. But it doesn't change the key dynamic, let's say, for businesses at the moment of their margins are severely compressed, their costs are still rising, they're wondering really when do more customers come forward. That stuff is far more important than these tweaks from the budget.
I wanted to try and get to a bit of long-term stuff now, if that's all right, and if we can just try and sort of think long-term. People talk about, I think the phrase, the great wealth transfer is one that's been thrown around, this idea that you've got a range of people probably hitting retirement now and getting on, and they're getting at the point where they're going to potentially hand that wealth to another generation and so on. I mean, people talk about that and how people have built that up and might leave it to their kids and grandkids. Are there implications of that for the property market?
We lack research on what is really going to happen. And even if one looks at research coming from countries which have already gone through ageing processes like Japan, Germany and a few others, it may not be entirely relevant to the New Zealand situation. And maybe especially when we've looked at one of the developments in the past 18 months is that with soaring local authority rates and insurance premiums and electricity prices, butter and meat, any spreadsheet a person has run for, this is what I can afford to spend in my retirement, it's all out the window. Any savings or investment calculations you made from when campaigns first were run by the government on Save for Retirement, late 80s, early 90s, it's all out the window. And so I can't help but thinking that some people have reached the conclusion, I'm actually going to have to spend more of what this inheritance passing on is going to be. Why should I sacrifice even more for these ungrateful kids or whoever it is situation? And so I think for the New Zealand context, it's really hard to figure out any implication for what's going to happen. However, when I was running through a little list earlier on of reasons why the housing market is subdued at the moment, and I did mention a lot of construction, a lot of supply out there, the employment market worries, low FOMO. I did make a little bit of a reference earlier on to investors doing selling, and that extra supply is on the market. Other investors come in, bring it up to healthy home standards, or young buyers come in and watch some videos and learn how to use a screwdriver and a hammer and do it up themselves. There's an opportunity to add value to one's property by undertaking long overdue maintenance on some of those properties. So I think that's one element in there from the retiring generation or already in retirement.
But is that like a wee blip, or is that like the start of quite a strong trend, if you like? Because there are a lot of people out there that would be facing those circumstances potentially.
It's probably a move up to a higher level of investor selling on average than was the case. So if it was chugging along like this before, it's now, I think, going to chug along at a higher level like that for a number of years. So higher average listings of property than would have been the case. So I don't think it's a blip, but it's going to be sustained. But that doesn't mean it sustains its negative impact on the market for a great number of years. It's just a bit more supply out there for buyers to choose from. And you have to think to yourself, from having all of us watch this housing market be so difficult for young buyers in particular for so many years, thank goodness. This is a really good story, quite frankly. But yeah, just to finish off with the passing on to the next generation, I don't know how that spins out in terms of how does it affect the savings and investment desire of the generation that think that they're going to get it. And you got to watch your assumptions, because what I'm increasingly hearing from people who are thinking about when they pass and then passing on the wealth, they're going to skip a generation, or they're going to skip 2 generations and give it to not even the grandkids, the great-grandkids, or something like this. Yeah. People need to watch their assumption about who gets the dosh.
You've got to wonder as well whether it's going to change people's approaches. Like, is it just going to be a straight roll into the same kinds of investments, property investments as before, or are people going to take different approaches as well?
Yeah, exactly. I think there's going to be more diversification in people's investment portfolios. When they need to save for retirement, etc., messages were getting hammered by the government from the early 1990s. It was soon after the share market had crashed in 1987. And people, I think, naturally moved towards other assets like residential property, assisted by interest rates falling dropping sharply in the early 1990s. Inflation went from averaging 11% to about 2.5%. Interest rates fell away. We had migration numbers getting stronger. It all came together to bring a lot more people into the residential property investment market from the latter part of the 1990s than we'd seen before. I think now that extra layer of people is slowly going to be dissipated away. We're still going to be left with a lot of people investing in residential property, but I think more people now are going to be looking at other areas in which to invest their money, be it either for retirement or for something special in 10 or 20 years' time. I think there'll be more diversification away from property, but still 1/3 of the population is still going to be renting. So the need for the rental population, the rental stock to be out there is still going to be strong.
Tony Alexander, thank you so much. And thank you for watching, for listening, whether you're on iHeart or straight off the app or Spotify or YouTube. Make sure that you hit that like and subscribe. Ko motu, that's us for this week.